Hi there everyone, it's the 22nd of January 2024 and that means it's time to take a look at what moved the markets last week. We're still early in the year, however we're seeing a repeat of some patterns that played out through last year as well as 2022. I briefly wanted to touch on why that is happening, as well as what that could mean for the price action in the near term. Now on screen I have three of the major US indices or ETFs that represent those indices. The candles are the S&P 500 and the year-to-date return for that is 2.5% or so. The Nasdaq 100 has really been making a run of it through January and is just over 5% for the year. However, the picture is quite different if we look at the IWM. That is the Russell 2000 smaller listed companies in the US, and that particular index has returned minus 1.5% for the year-to-date. This shows us the performance of the larger companies in the S&P 500 over here and the Nasdaq 100 over here is quite different from that of the smaller companies in the US economy. And in fact, just like much of last year, these indices are being carried by the largest companies in the world. Those companies that have been given the nickname, the Magnificent Seven. We can get a little bit more information about what's going on if we look at the performance of yields on US government bonds. Here we can see that all the different durations that are on screen, those being the 10-year bond, the 2-year bond, and the 20-year bond, are all up for the year. The yields have gone up, which means the prices of these bonds have gone down. What these bond yields tell us is that the bond market thinks that bond yields went too low towards the end of last year. Bond prices increased by too much. There's an inverse relationship between bond yields and bond prices, which further implies that investors are now thinking that the US Fed is not going to cut rates as aggressively as the market thought towards the tail end last year, or a November, December kind of time frame. Now, there is some evidence that is driving this thinking amongst investors. First of all, inflation is appearing to be stickier than people had thought, not just in the US, but in several other countries. Core retail sales in the US are still quite strong, which could make inflation stickier for longer. And the US labor market is still quite strong. Initial jobless claims coming in significantly weaker than had been expected, especially given how high rates are in the US, and they've been there for some time now. In addition to the hard data points that we've seen, we also have various Fed members saying that the market has gotten a little bit carried away and the Fed is unlikely to cut as dramatically as bets in the bond market and the equity market seem to indicate. We saw this pattern repeat multiple times last year. The market got very excited about the potential for a pause in rate hikes or even potential rate cuts. Market participants then took this way too far by driving up the prices of bonds and stocks. And then at some point, a data point was released, or a series of data points were released that made them realize, uh-oh, we've gone too far, and then we'd see a sell-off in both bonds as well as equities. But the position that the world is in right now is quite different from where it was at any point during last year. We have a Fed that's becoming more dovish as the data becomes apparent. Inflation, whilst it's taking a bumpy road downwards, is still trending downwards. And this means that even if rates do stay high for a little longer than expected, they are still coming down. And I think that through 2024, investors are going to flip-flop between these two mindsets. That is the pessimistic view of rates being higher for longer, growth slowing too much and potentially causing a recession, and the optimistic viewpoint of the labor market is still quite strong, inflation is dropping, and rates will come down even if they do come down slowly. Given how wrong central banks and the world's best economists have been about the macro picture through the past few years, I believe that investing purely on macroeconomics is a very difficult thing to get right. Almost none of the great investors of the past 100 years have made their money off of betting on macroeconomics. Instead, you'll find that just about all of the great investors have been successful by finding great companies that are fairly or cheaply priced, buying into those companies and holding on for the long term. Speaking of great companies, Taiwan Semiconductor posted earnings last week, and oh my goodness, were those earnings fantastic. It is very difficult for most companies at the moment to grow, and here we have Taiwan Semiconductor saying that they expect 20% revenue growth through 2024. Now, Taiwan Semiconductor is a very special company for a number of reasons. First of all, it's the world's leading company when it comes to making semiconductors, but also it's benefiting from the rise of artificial intelligence. Artificial intelligence needs a few key ingredients to operate successfully. One of those being processing power, and the other being data. I won't look at the data side today, but there will be companies that benefit from the amount of data that AI needs to store and work through. And TSM is just crushing it by being in the right place at the right time. Their moat is enormous. Other semiconductor companies have also risen along with TSM. It's easy to visualize this by looking at the semiconductor ETF called SMH. It bottomed out around October 2022 and has been rising aggressively since then. It did put in a new all-time high last week, and it could continue to rise through the next few years. AI is only going to grow. But given that the world is going through a growth slowdown, which is likely to last at least this year, there is a chance that it's getting to an overbought kind of level. Now I also have on screen TAN, that's this orange line, and you can see that it's basically gone the opposite direction from SMH from about March of last year. The reason for this is that TAN is a solar ETF, and as the cost of capital has increased, individuals and businesses have been dialing back their capital costs, capital investments, and so they've spent less on things like solar projects. However, the situation with solar businesses is almost certainly temporary. Around the world, governments are making huge investments into green energy. The world overall is transitioning to more sustainable energy sources. And so when I see anything like this, a growth market where prices have been beaten down, then I start to get quite excited. I am waiting for a bit more of a confirmation from central banks about the topic of rate cuts. But when that does happen, I expect to add a few more solar companies to my portfolio. So what is going on this week? Well, actually, there's quite a lot going on that could move the market. For example, we have some of the heaviest hitters in the stock market reporting earnings. You can see Netflix, Tesla, Visa, they're all reporting earnings through this week. One semiconductor company that I'm watching quite closely is Intel. One reason is that the US government is pouring money into this company and companies like it, hoping to grow a domestic version of Taiwan Semiconductor. In addition to this, the first half of the week is quite light in terms of macro data, but then we have some very important numbers. For example, the GDP number out of the US, initial jobless claims telling us about how hot or cold the job market is in the US. And by far, the most watched data point this week will be on Friday. We'll be getting the core PCE numbers. For those of you that don't know, that's the Fed's preferred measure of inflation. The market knows that this will form one of the key data points informing the Fed's decision on interest rates. And so any surprises there could determine the direction of the market on the day. All right, that's for this week. I hope you have a good one. Goodbye.